Hey everyone, Dan Vredeveld here with your Richmond Refreshers update. As you may have heard, a major new tax law nicknamed the One Big Beautiful Bill was signed into law on July 4th. Whether you're hearing praise or criticism about it, we believe the best thing you can do is look at what it means for you. So today, I want to walk you through 5 big things you should know, especially if you're retired or getting close to retirement. Now let's dive in. First, the tax cuts from 2017 are now permanent. That means today's lower individual tax brackets, those rates you've likely been enjoying the last few years, are here to stay. That kind of long-term clarity is a big win when you're planning for retirement. Second, there's a new bonus deduction for seniors. If you're age 65 or older, starting next year, you can deduct an extra $6,000 on your taxes. Now, this does phase out at higher income levels, but for many retirees, it could be a meaningful savings. Third, most retirees will no longer owe federal tax on their Social Security benefits. Thanks to the new deductions, nearly 9 out of 10 retirees will see their Social Security go untaxed. That can mean more stability and more peace of mind in retirement. Fourth, the estate and gift tax exemptions are increasing. Starting in 2026, you can pass on up to $15 million per person or $30 million as a couple, federal tax-free. So if you've been thinking about gifting, charitable giving, or updating your legacy plan, this could be a great window of opportunity. Fifth, the national deficit is projected to grow, and that has long-term implications. We don't know exactly how that will play out, but it's one more reason to keep your financial strategy strong and flexible. Now, let's talk about what all of this means for Roth planning. Even though the new law didn't directly change Roth accounts, experts believe we'll see even more of them in the years ahead. Why? Because Roth accounts are taxed up front, which gives the government more revenue now, helping offset the growing deficit. That means Roth IRAs, Roth 401ks, and Roth-style plans may become even more prominent. And if you've been thinking about doing a Roth conversion, here's some good news. The lower tax brackets from 2017 were originally set to expire at the end of this year in 2025. But now, thanks to this new law, those lower taxes are here to stay. That gives you more time and flexibility to convert at lower tax rates, especially if you time it alongside new deductions like the expanded SALT deduction or the senior deduction we talked about earlier. And finally, smart use of tax-advantaged accounts just got even more important. Many of the new deductions in this law phase out at higher income levels. By using strategies like qualified charitable distributions, IRA contributions, or HSAs, you may be able to reduce your taxable income and preserve deductions you might otherwise lose. So what does this all mean? It means now is a great time to revisit your strategy. Whether you're already working with us or just looking for a second opinion, we're here to help you, and we can bring your questions to your next Reconnect visit or schedule a quick call with our team at no cost. Our mission is to help you live fearlessly and into and through retirement, and to make sure you feel confident in every season. Thanks for watching, and we'll see you soon.